Thanks everyone for joining us. I really hope I can provide you with some actionable advice and information about what you can look for in terms of financing your small business now and also in the future. As Alexa mentioned, I'm Education Director for NAV. NAV is a SCORE Foundation sponsor, and we love working with SCORE because we know that when small business owners are working with a SCORE mentor, they're more likely to be successful. And so we see it as just a great partnership to be able to provide this information. Real briefly on my background, I've been involved in credit and financing education for many, many years now. I worked on the legislation that gave consumers free consumer credit reports back in the day, and the legislation that tells you what your credit card interest rate is before you get it in the mail. And I've written 5 books, and my latest was Finance Your Own Business. And so when it comes to the small business financing world, if you think consumer credit can be confusing, small business financing can seem even more confusing because there just aren't as many regulations and consumer protections. So I want to alert you to some of those issues and give you some heads up so you can make sure that you avoid potential pitfalls. You're always welcome to reach out to me. There's a couple of my social media handles and my email as well. So what I'd like to do today is, first of all, I'm going to talk a little bit about what's going on in the lending landscape. Then I'm going to bring in some important questions that you need to be able to answer if you're looking for financing. Then we're going to go into some of the specific types of financing that are available right now, some of the pros and cons and qualifications. And then we'll touch at the end on business credit, just because it tends to be something that's not very familiar to many small business owners, and give you some resources that I hope will be helpful. And then we'll hopefully have time for questions and answers as well. All right, so the lending landscape this year has been tumultuous, to say the least. We started the year with so many different options for small business owners, and such a great opportunity, regardless of the stage of the business or even the type of business, to find some financing that might work for the business. And then March hit, COVID hit, and it was like, the freight train threw on the brakes and everything came to a screeching halt. And at NAV, we work with a variety of lenders, and many of the lenders that we work with just stopped lending, and they just didn't know what they were going to do. So then the government stepped in with a couple of programs, the Paycheck Protection Program, or PPP program, and the Economic Injury Disaster Loan, or EIDL program. And these government loans were extremely helpful to certain small businesses. And some of you may have even worked with your SCORE mentor to get information and resources, or to help you apply for those loans, because it was confusing at first. And there's still some areas that we're trying to figure out in terms of PPP forgiveness, and SCORE has just been a great resource on that. Now, one bright spot throughout this has been crowdfunding. So I'm going to touch on crowdfunding in this presentation, but the crowdfunding actually took off during the crisis, and I think it's going to make a permanent impact on that particular type of financing. So we'll touch on it. Now, the good news is that we are seeing lenders coming back. So lenders are starting to lend again. Some of them have tightened their qualifications. So some of them are going to require higher credit scores or more revenues or longer time in business, and we'll touch on that. But it is opening up again. So I think going forward, it's going to be different than it was at the beginning of the year, but we are starting to see the lending market move again. So what I'd like to do is ask you what your experience has been during this time in terms of financing. I'd love to go to a poll and find out what you have or haven't done in terms of financing this year. So since March of 2020, have you applied for just PPP or EIDL or both of them? Or maybe you applied for government funding, also some private funding, maybe just some private funding, or maybe you're just nervous and you don't want to apply for anything. So I'll let you go ahead and use the poll feature to answer that and share what your experience has been so far. So far, I'm seeing quite a few people saying they haven't applied for any funding, but we're seeing a good response to those who have used PPP and EIDL, or PPP and EIDL and a private financing. So we'll give just a minute to finish tabulating some results. So what I'm seeing here is that just over half of you are saying, I haven't applied for financing, and that's understandable. It is an uncertain environment, so I can see why that might be the case. Those of you who have applied for financing, you primarily applied for PPP and EIDL. And so my guess is you're here because you want to find out what's out there and you want to find out what else might be available. And that's my goal, is to help you understand the financing options that are available now. So before you borrow, here are some questions I want you to be able to ask yourself. Now, you will get a copy of the slide deck, so you can always go and review this later, or you can take notes and think about these questions now. And if you don't know how to answer some of these questions, this is where it'd be a perfect time to meet with your SCORE mentor and talk about some of these questions so they can help you solidify what you plan to do in terms of getting financing to grow your business. So the first question I often hear is, how much can I get? Or how much, well, you'll be asked, how much do you want to borrow? And then the business owner will say, how much can I get, right? So you're wondering, how much will they lend to me? And this does vary depending on the type of product. A good rule of thumb would be about 70% of your gross monthly average revenues. So how much do you make on average per month? And if you go about by usually a 6-month most recent period, that's a good number to go from. Multiply that by 0.7, and that will give you 70%. That's a good rule of thumb. Now, there are some lending products that will go much higher. If you're going to get an SBA CDC loan to expand a facility, for example, you're probably going to ask for a lot more than that, but it's a secured loan, secured by the facility or equipment that you're financing. So there are ranges, but that's a good range for what would be a line of credit or financing that is more flexible. Now, if you have other financing already, that's going to lower the amount that you can qualify for. If you have excellent credit and you don't have outstanding debt, you might qualify for more. So it does range, but that gives you at least somewhere to start with. The other question that's really, really important to lenders is, how old is your business? And it's almost a magic number at 2 years. And I can tell you, because we work with many different lenders that now, we'll see that once the business hits the 2-year mark, the funding options open up more dramatically. So for you, if you happen to be a younger or newer business, you want to make sure that you have that line in the sand, that firm date when your business started. And one good way to do that is to have your business, to incorporate your business, whether that's an LLC, S Corp, or C Corp. That gives you a very clear start date. But some of you maybe aren't ready to do that. And so if you aren't going to do that, let me make a couple of suggestions. One is I would recommend you consider getting an employer identification number, EIN, from the IRS for your business, and that's for tax reporting purposes. And then you'll get a letter from them assigning you the EIN. You could use that as your start date. I also recommend you go ahead and get whatever licenses are required in your state for your type of business. Again, your SCORE mentor can help you with this. And then register your business name. So you should be able to register as a fictitious name or doing business as. So if you're not incorporated, or if you're incorporated and you want to do business under another name, you file a fictitious name. And that can also give you an official record of your business with your state Secretary of State or whatever state you decide to pursue your business in. And so that's a helpful step. Just make sure you use a consistent start date all the time. So you write this down, you keep a note of it, and when you apply for credit, you always use that same date so that you have that. And then the other tip, well, that will tie into another tip I'm going to give you in just a moment. So this is the next tip, which is, what are my revenues? And here, the key is to look at your business revenues. And to do that, you need a business bank account. Now, we saw so many small business owners during the EIDL application process. And that, by the way, EIDL, the Economic Injury Disaster Loan Portal, is still open. So if you haven't applied for that and you're considering it, you can check that out at sba.gov. And with PPP too, where they don't have a business bank account, or they're mixing business and personal purchases in the same bank account. And it makes it very difficult for them to apply for financing. Some of the lenders we work with will not extend financing to a business that doesn't have a business bank account. And some of them, if you're using it for personal purchases, that's going to make it more difficult to apply. So what lenders are looking for when it comes to a business bank account is a couple things. They're going to look at how many deposits your business is making. So if you only have one or two clients paying you each month, that's a high risk business, because if that client goes away, you don't have a business, right? Now, if it's a government contract, it might be a little more flexible there because they know that the government's going to pay those bills. But it's best if you have multiple deposits going into your business bank account each month. So that could be from individual customers, like you're accepting payments through your payment processor, or it could be through individual clients who are paying you each month, or you're depositing a check from those clients. They will look at low balance days. So if it's at all possible for you to find $1,000, for example, and park it in your bank account and pretend it's not there, that's great. If you can't, do what you can. One thing that you do want to try to avoid is overdrafting your business bank account, even if you have a line of credit. So sometimes you'll get busy and you think, well, I don't have time to deposit that check, but it's okay because I've got the overdraft line of credit and I'll just pay it back. But the lenders might see that activity as higher risk because you're drawing below the business bank account. So just make sure that you're looking at your business bank account as you would, as a lender would, and understanding how they might view it. We have done a survey at NAV where we found that business owners who don't have a business bank account are often rejected for financing. So if you're not using a business bank account, you're not using it strictly for business purchases, I would really encourage you to think about that. Next, we're going to talk about credit, but I want to find out what you've been doing in terms of checking or monitoring your credit this year. So let's go to a poll and let's look at whether you have checked your personal credit this year, your business credit, or both your business and personal credit. And some of you might not be checking at all. Sometimes you don't want to check. I understand that. I get that. Sometimes you don't want to know what it says. All right, so I'm not seeing this one sent yet, Alexis. Have we sent this one? Or should I go ahead and click the send survey button?
Oh, hi, Jerry. I am sending that right now.
Great. Awesome.
Okay. You should see that in just a moment.
Okay, perfect. I'm always curious with this question because there is more visibility now with business credit. And that's one of the things that we've done at NAV is help business owners check their credit. But business credit is still pretty much a mystery for many small business owners. So it's interesting to see how many people are engaging with their credit. All right, so what I'm seeing here is so far it looks like the majority of you are just checking your personal credit. There are lots of places to do that. I wrote an article with 138 places you can check your personal credit scores for free. So there's a lot of options out there, your credit card company, as well as websites like Credit Karma and NAV where you can check it. And then a small number I've only seen one person who's only checked their business credit, a small number have checked both, and about 20% have checked neither. So I do want to encourage you to engage with both your business and your personal credit because they can both be important. And I'll give you an illustration here. The Federal Reserve surveys small business owners every year. In their latest small business credit survey, they asked business owners who applied for financing, what did you use to get financing, your business credit, your personal credit, or both? And if you look at the orange button there and the dark blue, it adds up to 60%. And those are business owners who either use their business credit or a combination of business and personal credit to get financing. So we think both are important at NAV, and that's one of the reasons we provide access to both for free. Really encourage you to be checking your business and personal credit because you don't know usually what the lender's going to check. And so you want to be prepared for any scenarios that might pop up on the back end, so you can answer questions if lenders have a question about your credit. What is your industry? This is important because lenders might target a particular industry for financing. And this is usually identified by something called the Standard Industrial Classification Code or the North American Industrial Classification System Code, NAICS code. They're similar. NAICS is newer than SIC. You can actually, there's websites where you can look up these codes. They may appear on your business credit. So if you check your business credit for the first time, look at this code, just search it to see if it accurately describes your business, and then make sure it does. If you need to dispute it, you can dispute it. And the reason I suggest that is because some lenders want to lend into certain business industries and some don't. So we had a NAV customer, for example, who manufactures signs that real estate agents put in the front yard of houses they're trying to sell. And he was not getting the financing he wanted. It turns out he was classified, his NAICS code was classifying him as a real estate business, and he was actually sign manufacturing. So once he got that fixed, he had different financing options. So that's just something to keep in mind as you check your business credit to make sure it's accurate. Collateral is not required for all small business loans. That survey that I mentioned earlier by the Fed, they said that 38% of the business owners surveyed said they use some form of collateral to get financing. Well, one thing I want to just mention to you is that sometimes collateral is not physical items. You know, it's not that crane or that equipment. It can be other things like all receivables or all inventory. So if you, for example, got an EIDL loan for $25,000 or more, the SBA will file what's called a UCC one filing, taking an interest in the property or business. And the UCC filing is basically a document they file with the court that says, hey, if this business defaults, we have first dibs on this property of the business. And so these UCC filings are available in the public record, and they often show up on credit reports. So one thing we've seen at NAV with business owners who check their business credit is sometimes there's a UCC filing on there and they've already satisfied the debt, but the lender or financing source didn't file a release. They have to file a release with the court system to say, hey, this has been satisfied. If it's not, that could affect you getting other financing. So that's something you want to check if you are checking your business credit, because that could impact your other financing. Knowing your numbers is so important. And we saw this again with these government programs where business owners were having trouble qualifying because they didn't know the numbers. So I really encourage you to find a way to set up a system to make sure you're on top of your bookkeeping. Whether you have a bookkeeper who does it, whether you take a class through your local, SCORE SBA office on how to do your own bookkeeping, you really want this to be up to date because the lender may ask for certain financial statements. And if your bookkeeping program is up to date, you'll be able to just whip those off or ask your accountant to whip them off. But if it's behind, then that could impact your ability to get financing. So what we're seeing today of these that I've mentioned, revenues are very important. And so many lenders are going to ask for business bank statements, or they may even ask to tie into your business bank account so they can read the activity. This is read-only access. It's similar to what you use if you use one of these personal finance sites to check your financial situation each week or each month. It's a similar access. So it doesn't let them take money out, but it lets them analyze your bank account. So revenues are going to be really important. Again, the business bank statement, time in business. So the sooner you can take those steps to make sure you've established a formal time in business, that's helpful. Your business and or personal credit could come into play, and then your industry. So I've given you a few tips there. So let's go into some of the types of financing that you might be considering. So top tier financing, when I'm talking about this, I think this is what a business owner often has in mind is I'm going to go to my bank and get a business loan. And that's great. There are different types of business loans available from banks, credit unions, and community banks. A line of credit gives you a certain amount that you can borrow up to. As you pay it back, you have access again to those funds. A term loan is going to be usually for a very fixed purpose. So you need to borrow a 5-year loan to build out this part of your building, for example. You're going to pay it back in the same increments over that 5-year period. SBA loans I'll touch on in just a moment, and then commercial real estate loans. Now, we did see commercial real estate loans grind to a halt pretty much in March for many of our customers, but we're starting to see that open again. So it really is very geographic specific, so it might depend on what's going on in your marketplace, but we're starting to see those come back as well. Now, To qualify for top tier financing, you typically need to have good qualifications. So you need time in business, you need strong credit. Banks almost always check the owner's personal credit. And if you have multiple owners, they may check the owner's, multiple owners' personal credit. They may check business credit. They're going to look at the bank statements. They're probably going to want 2 years of business tax returns. But the one thing to keep in mind is that many banks are looking to make larger loans. So some of the biggest banks you'll see on their website, they'll say the minimum for this product is, $1.5 million. And maybe your business needs a smaller loan. So that's just a reality of some of this. So that's one of the first questions you want to ask if you're talking to a bank or credit union, is to find out what's your minimum loan size for what I'm looking for. Because that may tell you, if you want a smaller loan, it may tell you need to look at some of the other options we're going to talk about. In addition, SBA loans are loans that are guaranteed by the Small Business Administration. Now, with the exception of disaster loans, including the EIDL, these loans are not made by the SBA. They're made by individual lenders. And there are a number of different programs that they offer different loans under. So it's a little bit of an alphabet soup. 7A, the microloan program, the 504 CDC program. So we've created an e-guide that is on the SCORE website at that short link that you see there, score.org/nav, that goes through the different types of SBA loans, what's available and what they require. Couple things I'll point out real quick, and that is the most important thing to understand about an SBA loan is that the individual lender must follow the SBA requirements in order to collect on the guarantee if the borrower defaults. But they can add on their own requirements as long as they don't discriminate on a prohibited basis. So they may have a higher credit score requirement, for example, or they may decide that they only want to lend into certain industries. And again, as long as they don't discriminate on a prohibited basis, they're allowed to do that. So the tip for you is, just because you don't get an SBA loan from one lender doesn't mean you can't get an SBA loan from any lender. There may be another lender that may be a better fit for what you're looking for. Now, where do you apply for top tier financing? Well, you can certainly go to your bank or credit union. You may also find community development financial institutions, CDFIs, in your community. Some of these are for-profit, some are nonprofit, but they often have a mission to help underserved borrowers. And so those may be a good resource. And your SCORE mentor is often very tied into what's available in your community, both from CDFIs as well as local banks. And you can also use the NAV marketplace, which I'll talk about later, to shop for financing, including for SBA loans. Now, alternative financing. So many business owners are not going to qualify for a bank loan. And so they're going to look for other types of financing. And so I want to jump into a couple of these options right now that are most prevalent and most available right now. But before we do, I want to ask a quick survey and find out from you, of the things that I've listed here. I may have not listed all your ideas here, but what would you say would be your number one obstacle to getting financing from these items that I've listed here? Do you feel like your credit score is probably too low? Are you concerned about other aspects of your financing? So go ahead and weigh in terms of what your personal obstacles might be. I'm seeing a lot of folks who are challenged with the revenue part, and that's understandable. This is a very uncertain environment for many businesses right now. Credit scores, not sure where you can get approved. A number of you are afraid to take on debt right now, and that's definitely understandable. And again, working with your SCORE mentor is going to help you look at things like, hey, I'm not making revenues from the line of business that I used to be. What other ideas can I pursue to see if I can bring those revenues back up? And that may be a great way to look. So number one seems to be revenues. Number two, very close between afraid to take on debt, not sure where I can get approved, and credit scores. So we'll give you some resources for all of those. All right, so let's talk about some credit flexible options, or more flexible in general options for small businesses who may not be a great candidate for bank financing. Cash advances, this is where you get financing that usually has a daily or weekly payment. It originated with credit card sales, where they would look at your credit card sales, advance you based on those, and then the payment processor would take the payment right out of the next time your customer swiped a credit card payment. Now it's expanded beyond that now, so there's more of these products available, but the tip is if it expects a daily or weekly payment, it probably falls under this category. It's usually very flexible because it's based on primarily on the owner's revenues, and credit scores are not that much of a factor. There's going to be usually a soft credit check just to check that the owner's personal credit, they're not in bankruptcy or other, it's really, really low credit. But it's usually pretty flexible that way. However, it's often a higher cost form of financing. And sometimes it's confusing to understand the cost of financing because you don't always understand how it's calculated. And I'll give you a quick example of this. And by the way, all of these types of finance that we're talking about are in the SCORE e-guide that we created that is on the SCORE website, that page that I mentioned earlier, score.org/NAV. So with this type of financing, they usually express the cost as a factor rate, not an interest rate. So there's currently no requirement that small business lenders show you an APR or interest rate. Now, California has passed legislation that's still in the implementation phase, and New York has passed legislation they're waiting for the governor to sign that would be a Truth in Lending Act for small business. But currently it's pretty wide open in terms of how they express the cost. So a factor rate would be like if you get $100 advanced and it's a 1.2 factor rate, you just multiply that 100 by 1.2 and you get 120, and that's what you have to pay back. And then they'll take a percentage out of your future revenues in order to pay that back. And this is a free calculator we have at NAV. It's just on the NAV website, nav.com/calculators. And what it does is it translates it to an APR. And so I used an example here, and it translated a factor rate of 1.2 to APR of 38%. Now, that may be the best finance you can get right now. And if you can make money at that rate, that's great. But if you don't know and you don't understand, you might pass up other opportunities. Maybe you have a credit card that's at 16% that you'd rather use because you didn't realize this was a 38% interest rate. So I want you to be really cognizant of what the financing costs so you can make sure that you shop around. Invoice factoring is used by a lot of types of businesses that typically invoice clients. So it might be you have a construction business, retail, fashion business. Anytime they're going to pay later and you have an invoice outstanding because you've provided the services, there are companies that will step in and collect from your customer and then pay you money up front and then pay the rest minus their fee when they collect. Now, many business owners are a little bit leery of this because they're afraid their customer might think they're having financial problems. So I can tell you it's very common in certain industries. So many businesses don't, bat an eye at it. But some new technology has come up where they will actually have the payment go to a special PO box where it looks like it's going to you, but it's going to the factoring company. They're going to collect and pay you, or it's going to go to a bank account where, they take their cut. So it can get pretty creative. Microloans are smaller loans for small businesses. There's no legal definition. The SBA has a microloan program that goes up to $50,000. And in the SBA microloan program, the average loan amount is about $14,000. So these can be really nice for businesses that maybe have trouble qualifying for other financing because they're usually offered in conjunction with economic development organizations or those CDFIs that I mentioned. So they're trying to help certain disadvantaged or underserved entrepreneurs. And again, a great place to start your search is talking to your SCORE mentor. There's also a website, the OFN, Opportunity Finance Network, OFN.org, that has a list of members on their website. And that could be another place. They're often very geographically limited. And so you're looking for ones typically in your area, although there are some that do operate in larger geographic areas as well. The nice thing is they can often be more flexible with credit, and the interest rates are usually pretty good as well. And then vendor terms. So NAV was co-founded by Levi King. His first business was sign manufacturing in Idaho, and he was raised on a farm where he was taught that credit and debt is bad. So he had no credit whatsoever. And cash flow was always an issue. He'd get a client who would want him to build a sign. He'd have to pay for the steel and the plastic and the installation and labor, et cetera, and then collect the balance from the customer. And it was always a problem. And then one of the suppliers said to him, you can fill out a credit application. You don't have to pay for all this up front. And he says that was a light bulb for him because it really improved his cash flow. So vendor terms can be a really attractive way for you to get things that you need in your business and then pay for them later. So you can talk to your suppliers and your vendors that you already use to see whether they offer credit terms. Or if you can't find any, you can also go to this short link, nav.com/vendors. That's just an article that we keep updated with vendors that generally don't check personal credit, easy to get business credit. Sometimes you have to make a couple purchases first so they know you're a legitimate business, but then they'll extend net 30 terms. You pay in 30 days, and they also help build business credit. So that could be an advantage. Now, many businesses fund their businesses through retirement funds. And there's pros and cons to this. One way is to just take money out of your retirement accounts, but depending on the type of retirement account and your age, you may pay taxes and or a penalty for early withdrawal. So make sure you check that with your accountant. If you're still working and you start a business on the side, or you have a partner or spouse who is still working, you might borrow against a 401k where you can pay it back over usually 5 years. And those are pretty flexible. And then there's also a program called the Rollover Business Startup, where you roll over retirement funds into a dedicated S Corp that is used to fund the business. And that's often popular with franchise businesses where someone has retirement savings and they fund their franchise that way. The caution I would say is that we have a retirement crisis in America, and many people don't have enough money for retirement. And so be very, very careful, because starting a business does carry some risk. So you don't want to be in a position where you have taken unnecessary risk and then you've jeopardized both your retirement and your ability to start your business. So just look at all your options and determine what's best for you. So we're going to touch on one more type of funding here, and then we'll go into a couple of tips and some questions, and that's crowdfunding. And I'm going to let you think about this one. You don't need to answer a poll for this one. You can just think about it. I want you to think about what are the 4 types of crowdfunding that are out there for small businesses. And the picture you're seeing on the screen is from Cowboy Cricket Farms. And I had the tremendous honor of a couple of years ago of presenting them with an award from a SCORE grant for their business. They won in the veteran-owned business category. And this is a young couple who very quickly have become the largest producer of food-grade crickets in North America. And so they make cricket snacks, cricket flour, and then they sell chocolate chirp cookies made out of their cricket flour. And they, after the award, I, kept on their mailing list, and they had a crowdfunding campaign because they wanted to introduce new flavors of cricket snacks. And so I backed their campaign. And everyone who backed it when they were successful got a box with the new cricket flavored snacks, and they were really good, by the way, and a chocolate chirp cookie. And so that was an example of a very popular type of crowdfunding that's known as rewards-based crowdfunding. That's where you offer a reward for people who back your campaign. And a great couple of well-known platforms for this are Kickstarter and Indiegogo. There are others that are specialized. Those 2 are well-known. If you've never spent time on one of these platforms, I would encourage you to at least check it out. It's really fun to see what kinds of businesses are getting funded. There's also a type of funding called debt-based crowdfunding, and a great example of this is Kiva, KIVA.org. Kiva is a nonprofit, and they offer 0% loans to small businesses. Right now, it's up to $15,000 for businesses in the U.S. because of COVID. Normally, it's $10,000. And it's a 0%, zero-fee loan. But lenders are people who want to support small business. And so they're not expecting a return. They're doing it more as something philanthropic. And so that's something you may want to check out. You do pay it back over time, but right now they've even paused payments because of the COVID crisis. Equity-based crowdfunding is where you can raise money for your business. And I am super excited to see the statistics of how this is growing right now. It's really, really interesting and exciting. And a lot of different businesses are getting funded this way. So if you've ever thought, I want to get angel funding, or I want to get venture capital, that's very, very hard to get. But equity crowdfunding might be your best option. So there is a webinar on the SCORE website with one of the top experts on this in this field. I would highly recommend that webinar. So go to score.org, search for crowdfunding. You'll see the webinar on equity-based crowdfunding. I encourage you to check it out. And then donor-based crowdfunding is where where people are donating to help a business. It wasn't huge for small business maybe a year ago. I mean, it was there, but now it's grown tremendously with COVID. So GoFundMe they're the best known in this space. They've stepped up with donations and grant programs for small business. So it's certainly something you may want to check out. Now, the key with crowdfunding is that you need to be able to reach people who want to support you. This type of funding can work for startups. They don't care about your credit. It's flexible in terms of uses. It's often very, very cost effective, but it does require you being able to reach your target audience. And so you need either a social media following, you need an email list, some way to do that. So as we go through this year, I think one of the lessons we've learned, besides, having that business bank account, keeping your books up to date, is to make sure you have a way to stay in touch with your fans and followers. So choose your method and really cultivate that, because that can make a big difference in terms of getting financing. All right, so I'm going to quick touch on business credit, but we're going to make it a little bit short because we want to make sure we have time for your questions. Business credit matters because it can affect your getting insurance and bonding, government contracts. If you want to work with the big companies where you want to get your product into their stores, they'll probably check business credit, but also for certain types of financing where they may check your business credit. So it's really important to make sure that you at least know what's going on in your business credit reports. And there are 3 major commercial credit bureaus, Dun & Bradstreet, Equifax, and Experian. I encourage you to check all 3. And then there is a FICO score that is used in some small business lending decisions. It's called the FICO SBSS score. And if you're thinking about an SBA loan in the 7A program, which is the most popular program, for $350,000 or less, the very first thing the lender has to do is pull this credit score, and it can combine the owner's personal credit, the business credit of the business, and it can even include financial data on the business as well. The score runs from 0 to 300. 300 is the best score you can get. And if you have multiple owners in your business, anyone who owns 20% or more, there will be a personal credit check involved for this credit screening. So everyone needs to be upfront. If you have partners in your business, you need to be upfront with each other about your personal credit scores, because that could come into play. The SBA recently raised the requirement for this score for the pre-screen from 140 to 155 out of 300. But I can tell you most lenders have already been looking for 160 to 165, so I don't expect it to have a material impact on what most business owners can qualify for. If you are interested, if credit is your hurdle, and I know some of you mentioned that in the poll, there is a webinar that we've done previously where we talk about credit strategies for small business owners. So that is on the SCORE website, and I'd encourage you to check that out. All right, I'd like to give you a couple of resources here, and then I will be happy to try to answer some questions. I know we've covered a lot, but again, we've got backup materials so you can dive in deeper to any of these options that you might be thinking about. So first of all, at NAV, I did mention before, we do provide business owners with free business and personal credit scores. This is truly free, no credit card required, and it doesn't impact your credit scores. But then ultimately, we're going to use that to help you find financing options. So we're a marketplace, not a lender. We work with 110 plus different financing sources, and we're going to show you options. We won't sell your information to lenders to call you, but we'll present you with offers that may be a fit. And we have a team who's happy to talk to you, no pressure, about your financing questions or your financing needs. So if you do decide to check out NAV, all we ask is that you go to nav.com/score, because that way we'll know you're working with SCORE, you're working with your SCORE mentor, and we want to make sure we respect that relationship. In addition, the most fun thing we do at NAV is we offer a quarterly small business grant for $10,000. We're just wrapping up our third quarter 2020, and we'll get ready to open up our fourth quarter 2020 grant soon. And I'm pleased to say that we have had, in our last round, one of our runners-up was referred by their SCORE mentor, and they won one of the runners-up prize. This is our last winner, Shea Butter Jones, a food truck in Atlanta. A lot of fun to award them this grant. So certainly feel free to check this out and see if it might be a fit. And if you want to apply in the next grant round, we'd love for you to do so. All right, so here is my contact information again, so you can reach out at any time. And I think at this point, Alexa, we're ready to answer some questions.
Okay, Jerry, sounds good. Can you hear me all right?
Yes.
Okay, great. So we'll move into the Q&A segment of the webinar. We're going to do our best to address as many audience questions as possible in this time remaining. So, Jerry, there were a lot of questions coming in around checking business credit. If you could elaborate on how can people check their business credit?
Yes, great question. So there's no federal requirement like there is with consumer credit that they give you your credit reports for free. DMB does have a free product called Credit Signal.
Understanding cash flow.
And Experian has had
What
a free
do you
credit
think an
report this year
entrepreneur would tell you if you
COVID,
asked them?
But I don't think it's free anymore. And Equifax, you purchase one. So we want to make it easy at NAV. So that's why we show you DMB, Equifax, and Experian for free. And we're the only source for all three for free. So I feel comfortable not referring to someone else here because there's no one else who does that. So you just go to nav.com/score and just put in your business name and go through the process there. You can sign up if you don't have a business yet. So if you don't have a business yet, you can still sign up. And then once you start your business, then we have tools to help you build business credit. So it works either way, whether you started your business or whether you're already established.
Okay, there were a few questions around this next question. This one is from KL. Around the rule of thumb for the loan amount, asking, is it 70% of gross revenue or is that net profit?
Average gross monthly revenues. So that now the 70% is just a rule of thumb to give you an idea. And again, it will be impacted. So if you have other financing, one thing I would really encourage you to make sure you do is be upfront with any kinds of financing that you have with whoever you're talking to, because we have had the experience working with small business or at NAV where sometimes they just don't disclose it. And then it comes up in underwriting and it impacts the amount of financing that they can get. So use that as gross, use your average. And I would average it around probably the last 6 months. Each lender might have their own nuances. Now, one tip real quick is to understand that if your revenue has been declining each month, that will impact the amount you can get. So they will look at trends.